I'm Owen Bigland. This is the Inside Edge video blog. Okay, if you've been following me on Twitter, I've been posting some of my winter reading list, and I've made a New Year's resolution this year in 2021 to read a pile of books. I always read a lot of books, but I've kind of set the goal even higher this year. So I've been ordering a lot of books. I tweeted out this one, and I've talked about it one time before, is this The Psychology of Money by Morgan Housel. So I finished this book a couple weeks ago, and I've marked some areas that I really like in this book, and I'm going to definitely keep this one in my active library here to go back to time and time again, like some other books that I've got here. Strongly recommend you guys read this book. The fantastic thing, it's a very easy read. They keep it simple. And I think you'll even notice a few similarities to my book, especially my first couple of chapters. I talk about the psychology of investing, the mindset, the buy and hold mentality you have. And that's what this book pounds home, and as have a number of other recent books I've bought. It's nice to see this now. These investment books kind of, they get the kind of the theories behind a lot of these books come and go. You know, sometimes they get into growth investing and investing in tech and high growth companies. I'm noticing now in a lot of the books, it's a back to basics approach. And that back to basics approach is forget about trying to trade stock, or forget about trying to trade in and out of real estate, especially because the commissions, the taxes, the friction costs with real estate are 100-fold what they are in the stock market. But Morgan Housel here, breaks it down about just index investing. Buy the broad index, or buy the best companies and hold them. Collect the dividends if they pay a dividend and just keep reinvesting them. Let compounding, the eighth wonder of the world, do the magic for you. He talks about, Warren, and I've seen this stat before. They always say, in investing, the first million is a bitch. And it's true. I can tell you from my personal experience, that first million in my investment account took a long time to get, probably over 20 years of investing. The second million, the third million, everyone from that point on gets a lot easier and a lot quicker. And he talked about Warren Buffett, I think, was 51 or 52 years old when he became a billionaire, 1 billion. In the next 20 years, he's taken that billion to something close to 80 billion. That's compounding. And that's why a lot of people fail investing in both real estate and saving for their retirement or in stock investing, because it takes time. You don't see a lot of returns or a lot of results in the first 5, 6, 7, 8 years. Compounding needs time to take off. And what this book talks about, and a couple of others that I'm reading that I've tweeted out, it's not about hitting what they call the 10 baggers is fantastic. Companies you buy and they go up by 1,000%. I've got some of those. I've been lucky. I've got some chip makers. Apple, I'm up probably 1,000% on over the years as well. I've got some of those that I'm up 5, 6, 7, 800%. They're wonderful. But those are kind of 1 out of 1,000, as Morgan Housel points out here. Those are great. Try and shoot for some of those. But your real wealth will be created by the ones that are kind of just growing at 3, 4, 5% a year. Plus maybe they pay you another 2 or 2.5% dividend. So let's say it's growing at 7%. Those in time and compounding at 7%, you'll double your money every 10 years or so. So that's nothing to sneeze at. If you've got $1 million portfolio that's earning 6.5%, 7%, maybe 4% growth and another 3% in the dividend, you're going to turn that into $2 million in about 7 or 8 years. You're going to turn that into $4 million in another 7 or 8 years. That's where wealth is created. It's a slow, methodical process. I did that number I told you guys a while back. He also mentions in this book, if you've got someone who invested in 1980 and put $10,000 in the S&P, $10,000 for the next 40 years left it there. If you took that same investor who missed the 5 best days over the last 40 years, that portfolio would be worth $38,000 less. That's the price you pay for trying to churn and get in and out of stock. When the best of the best in Wall Street have a hard time beating the indexes, why bother? You don't have a hope. Buy good quality companies, let them compound, keep reinvesting the dividends, and then, you don't have to be sitting at your computer and trading. These guys, these day traders, they spend 8-10 hours a day trading, and they're just barely eking out a better return than the index for the most part, plus all the commissions and taxes they've got to continuously pay. Why not just build a bulletproof portfolio? You can take some of the examples I have in my book of good blue chip companies and good low-cost ETFs from Vanguard, and then use that 8 hours in your career. Work, make money, move up the corporate ladder, whatever. Start a side hustle, start your own business. That's where it's at. That's where you're going to create incredible wealth. Because I've read a few books here and some stuff online recently about what a fool's errand it is really to try and time both real estate or the stock market. I mean, if you think about it, the S&P 500 as I speak is at all-time highs. The TSX just crossed a historic high here. We're going to have a pullback here, folks, this year. I mean, we're still under COVID. There's lots of bad news that can happen here and will happen in 2021. I'm expecting at least 10% pullback this year, maybe 2, maybe something more. As sure as the sun's going to come up, we're going to get some pullbacks in the stock market here. And I've seen people already saying, correction is coming. But ask yourself, it means nothing to me, just like it didn't earlier in 2020. The S&P 500, it was classified really as a crash, a mini crash. If you blinked, you missed it. But the S&P 500, the Dow dropped over 30%. I think it was 34%. That is a sharp, and I've never seen such a sharp correction. Way sharper than what happened in 2008 that I lived through. But if you watch my blogs at that time and my Twitter feed, it meant very little to me. I wasn't worried a bit. I didn't lose even a minute of sleep. As a matter of fact, I was buying whatever I could. It was the opportunity of a lifetime, as I was saying on my Twitter feed, which it turned out to be. Many of those companies, I didn't think they would recover this quick. Nobody did. But I'm up, 100, 150, 200% on some of those stocks I bought. And these weren't small cap stocks. These were blue chip. I mean, FedEx alone, I think I'm up 150% on when I was buying it back in March. But ask yourself, we're going to get a correction. So what are you going to do here? We are going to get a correction. Should you sell your entire portfolio, $1 million or $2 million or whatever? Pay all the commissions to sell it. Pay the tax man. Because remember, when you're selling assets, real estate or stocks, there's friction costs there. You've got commissions, but you've got taxes. You've got capital gains tax on that. So you're like taking one step forward and half a step back. And as Morgan Housel points out in this book, it doesn't make any sense. Why would you try and time it and get in and out of it like that? You're paying the tax man, the commissions, and then you've got to hope the market goes down and then buy back in. The better way to go is just stay the course. If you've got the right companies, you shouldn't worry. They will rebound. They always do. I saw some misnomers out there too, and I've seen this a few times. People were saying dividend stocks, bad time to be in dividend stocks because during COVID here, so many of these companies have cut or eliminated their dividends. That is a lie, folks. This is just made up stuff. Out of the 35 companies, Canadian and US individual companies I own that pay a dividend, I can only think of 3 or 4 that froze their dividend. And 2 of them have now put it back on. One of them being Estee Lauder just recently. I've only got a few that have still curtailing their dividend. Disney being one of my main holdings, but they're going to reinstate that this year. Stock's trading at a 52-week high. A lot of fake information and a lot of lies out there, I find, and you got to be careful. I'm going to do a blog later here on this winter on mastermind groups and surrounding yourself with the right people and taking in the right information. I've done this a few times before. But even one step better, I can tell you, I'm still compiling it now for my year-end stuff with my taxes and things. But I would say at least half of the companies I own that pay a dividend raised their dividends in 2020. They kept raising them. I mean, I've got companies that are already committed. I can think offhand, Fortis and Northland Power that are just, slow and steady, that have already, Enbridge even, that have already committed, these companies, TELUS, to continually increasing that dividend. They don't go off on it. Johnson & Johnson, Apple will continue to grow that dividend, Visa. So keep that in mind. You will get some dividend freezes, but for the most part, if you buy the right companies, the good ones that are highly profitable, wide competitive moats, crazy cash flows. You know, it was a little bit of a touch and go time there for all of about 5 or 6 weeks during COVID, but they've continued to pay their dividends and most have raised them. But that's what you want to be owning. Don't get cute. Don't try and time a market. It's not going to work. Just buy, hold good quality companies and keep adding to them. And on these pullbacks, if you can, try and get a little bit of dry powder. I mean, I'll be honest, right now, I'm still nibbling on things. I'm always buying stock because I've always got dry powder coming into my portfolio every week. When you own as many companies as I do, they all pay a quarterly dividend. Every week I've got cash coming in. And then I'm also every month putting new money into my accounts. But right now, I'm nibbling on a few things, but I've got my RSP now fully loaded for 2021, and I haven't put anything and bought anything yet because I'm kind of would like to see a little bit of a pullback. These prices are crazy, but I'll also set a time frame on that. If the market still continues to, kind of stay where it's at or even go up further, eventually I will slowly put that money to work in companies that I think are at least good value, reasonable value. But everything right now that I own is at or near 52-week highs pretty much. But that's the thing. You use those corrections, keep a little dry powder and buy. But I never sell, as I've told you guys many times before. I never sold a share back in March and April. Not one. I was a buyer. Just like I have in 08 and 09 and all the other corrections like that as well. But I really recommend this book. Morgan Housel's The Psychology of Money. Really easy read, keeps it simple. Because money and saving for retirement or buying your first home or investing in real estate, as I've said in my book, you have to get your mindset right. You're an investor, you're not a speculator. Don't get into the speculating game. If you want to do it with a little play money in your TFSA, trade a little bit of stock on Robinhood or whatever, okay, but make sure most of your holdings, your foundation, 95% of it is a buy and hold strategy. I'm Owen Bigland. See you next week.